Thanks for tuning in to our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So the S&P 500 is in what I'd call a mild correction currently. It's fallen about 9% or so from its peak. So this chart is a good way to just put into context the frequency of these corrections. Note that 5% or greater corrections have happened an average of over 3 times per year. Even 10% corrections happen a little more than once per year. Now, it might not make it feel more fun in real time, but knowing that corrections are quite normal in the course of a calendar year might help to alleviate some investor concern. Now, speaking of the correction, the current one has left the market somewhat oversold, and importantly, investors have become quite pessimistic. So, this chart in orange shows a sentiment gauge from Ned Davis Research that's plunged down to a level that's historically been consistent with a short term rally. So we would expect some sort of relief rally attempt here in the upcoming days and upcoming weeks. Now, whether we rally may not be the best question. Rather the quality of that rally might be the best question. We want to see a very high percentage of stocks, industries, and global markets rallying together. So this chart shows the percentage of US stocks that are trading above their respective average price of the past 10 days. Historically, when that indicator has reached 90% or more, the market's been higher 41 of 43 times 1 year later, and the gains have been better than average. So we want to see indicators like this one here giving us that all clear signal. And then we want to see longer term indicators like this one confirming that the bull market has reasserted itself. This indicator measures the percent of sub industries that are in a bull market. Now, it's currently lower than we'd like to see, so we want to see some improvement in longer term trend indicators like this as well. Now, one of the reasons this correction has materialized is that investors are recalibrating their expectations for Fed policy. There's still a higher probability of another cut before year end than a hike, but it is notable that there's a chance for a hike at all. Before the Iranian conflict, there was really a zero probability being priced in by market participants that there was going to be a hike this year. Now, that recalibration is manifesting itself in higher treasury rates. The 2 year treasury has rose to a level that's tended to be a headwind for stocks. Other than commodity prices and interest rates, we're watching the health of the labor market. So this chart shows that corporate profits and job gains have a positive correlation with each other. This is a circular relationship where higher profits support hiring and new jobs support higher profits. But the labor market has slowed significantly. This chart shows that job openings, the hire rate, and the quit rate are all much weaker than they were in the 2022 inflation impulse. We avoided recession in 2022 in large part because of the labor market dynamic. It's questionable if consumers could handle another inflation impulse today. For now, corporate fundamentals are strong. Analysts are currently expecting almost 22% earnings growth for 2026. Now, that's likely too optimistic, but solid earnings could support economic growth. With Q1 coming to an end here, we'll be paying attention to the earnings reports. We'll be noting if companies are broadly feeling pressure on profit margins or if they're still seeing a positive environment out there. So, wrapping it up, it's not a fun experience, but corrections are very normal. That's especially true in midterm election years. Now, the market correction has created an oversold condition, and investors are pessimistic. That condition is likely to launch a relief rally in upcoming days and weeks. We'll watch the quality of that rally to determine whether the coast is clear. One of the headwinds here has been the recalibration in Fed rate expectations. Treasury rates have climbed, and that creates a headwind for stocks. We're also watching the incoming labor market data. Payroll additions tend to support spending, creating a virtuous cycle. That cycle is at risk of being disrupted on more labor market weakness. But for now, fundamentals are solid, supporting stocks and the economic outlook. So that's what we have for you today. And as always, I want to thank you for listening in and wish you a great week ahead.